So you had a lot of questions about products and strategies and how you do that. And that's what this panel is all about. So Liz, it's all yours.
All right. Thank you. Welcome. So we're here to talk about ESG and performance. And we are very fortunate not to focus on age, but really do have 4 pioneers here in the industry. And as ESG and impact has mainstreamed over the most recent years, there are lots of people who have jumped in. But I think it's going to be really helpful to have folks who have been doing this before it became a front page story in Barron's, and while everybody was trying to justify that this wasn't, sort of funky out there, hippie kind of investing, and why it works. So let me briefly start. I was asked to talk a little bit about terminology. We can all sit here, and I think you heard this in the last panel, and put names and create taxonomies as to what it should be and what language to use. I'm just going to go with the way my firm looks at it, which is whatever language you want to use is good. We'll meet you there. And rather than trying to force stuff. And there has been an evolution of the taxonomy, and some people get very particular and spend lots of time, and I suspect folks at all of these firms spend lots of time thinking about what's the right marketing words and how should we talk about this? And is it SRI, and is it values alignment, is it mission aligned? Is it ESG? Is it ESG integration? Is it impact? And it doesn't matter. It's whatever works for you and kind of wherever you are. So we're not going to spend any time on that. The other evolution that you'll see here is, in the history of this, is moving from something that was viewed as either something the faiths did because it was prescribed by their religions, be it Catholic or Barbara had talked about Unitarian, where you were able to tie to very specific value sets, to something that moved into sort of the hippie era, and my firm is headquartered in the Bay Area, so, be it California, San Francisco, or Madison, Wisconsin, or Boston, Massachusetts, pick your area of this. And what's happened is this has moved more mainstream. And some of our speakers here represent that mainstreaming of it. Bruno was doing it on Wall Street before anybody else at Wall Street was acknowledging that this was something that should be done or made even sense. And John Goldstein, who was with Imprint Capital, recently acquired by Goldman Sachs, was really kind of the top of the acknowledgement by Wall Street that this is a thing. It is a real thing, and one that is worth real, serious investors paying attention to for whatever reason. So that's where we're going to be talking about this. So what I want to start with is asking John to set some framework around how this works across asset classes and in different structures, and why it matters. So John, if you want to start there.
Great, thanks, Liz. And I think I wanted to go through the lens, and sorry, I will get into a tiny bit of terminology, but really grounded in what I see as the 3 sins of how people talk about performance around ESG. So 3 sins. And it's funny, since the acquisition, I've spent a year talking to probably 450 of the firm's largest clients, and this list comes from a lot of shoe leather in terms of how do people get the performance conversation wrong. Number 1, they pretend this is all one thing, and it's not. Number 2, they pretend it's something other than investing, and it's not. Number 3, they demand a level of proof that they wouldn't ask of any other investment question. Do you ask, does investing work? No. You say, it's hard, and we're going to use good care and diligence process to do it well. So those are the 3 sins. So a second on each of the 3 sins. So number 1, it's not all one thing. To your tiny dose of terminology, sorry, we divide the world into 3 things, and the performance conversation is slightly different for each of the 3, which is why I do it. It's not for the glossary reasons. It's to ground the performance conversation. Number 1, alignment. How to get efficient passive market exposure, but with higher degrees of alignment to a factor, a variable, a priority, or a value. This is something Liz and her firm, as well as others, know an awful lot about. In our experience, and Liz, maybe you can chime in, you can design highly risk-managed, scalable, efficient ways to get market exposure with high degrees of alignment. And it could be around carbon emissions, it could be around fossil fuel divestment, it could be around a whole host of issues. But so alignment, can I get my basic market exposure, but with a high degree of alignment with an issue or a value you care about? I don't know, Liz, in terms of data or other ways you think about the fact that have the things produced what they're supposed to produce in your guys' experience?
In terms of alignment?
Yeah, and in terms of at the end of the day, you have a tracking error budget and you hope to deliver risk-managed solutions with a high degree of alignment. In your experience, is that possible?
Yes, and we've printed papers on it, and we quantify it by tracking error, and we'll talk about the different ways of approaching it.
And so back to what it is and how you measure it, alignment, it's basically incremental units of alignment per unit of tracking error, and then performance relative to how something was designed. ESG integration. In some ways, it's the opposite. Alignment is about the immateriality of these considerations. ESG is all about materiality. It's how can thoughtfully integrating environmental, social governance factors as part of a well-managed active investment process, public or private markets, help outperform conventional peer groups and benchmarks. And I think this is an area where labeling is really confusing. We see wonderful people that would deny to the death they're ESG investors. It just happens they see human rights as deeply material. Right? And I think the labeling, and this gets to my second sin, the label is huge, but I think all the academic data, the meta study, 2,100 underlying studies about financial performance, link between ESG and financial performance, out of those 2,100, 90% found a neutral to positive relationship. We can all go, I don't know if any others have your favorite studies to cite. I think we like to say ESG is not magic and it's not poison. Right? It doesn't magically elude the laws of physics and investing, but it doesn't fundamentally detract from it. And I think, I don't know if, once again, people talked about sharing data. There are lots and lots of studies done. I see folks from Morgan Stanley here. Morgan Stanley has published an analysis of mutual funds. Morningstar has done the same thing. There's a lot of data, and once again, I think it's important, back to my third point, don't say it magically says this is better, but can this hold its own? I think the data seem to show. I don't know if any folks want to add on the data front.
Sure. So why don't we talk briefly about performance across each group? Do you want to kick off, John, or what you've seen across asset classes, or we can...
Yeah, maybe I'll finish on the impact piece, and then we'll kind of circle back and we can deep dive, and maybe at the end we can get back to the last two sins, which it sounds like from what people said, they understand them and they may be self-explanatory. Impact investing, private investments with measurable social or environmental impacts at the core of the business model. We further divide that into market rate investments, concessionary investments, and philanthropic replacements. People always want to do impact investments. Is there a concession? The answer is it depends, right? If you're investing in an area where there are drivers of growth and profitability, where the valuation and pricing environment is such that one can make money, and we heard earlier about things getting bid up, we like niche markets that aren't picked over. Some of those happen to be impact markets. Not all of them, but some of them are. And the third, you have to have a high-quality GP you can partner with to invest in the space that knows it really well. And generally, what you'll find is you're co-investing with purely commercial investors. We came back from an annual meeting in Investee. We were seeing between Temasek and the Nature Conservancy. And I think that gets back to my second sin. People think this is the people in Sausalito or other Bay Area locales sitting in a drum circle thinking about math. And the reality is often these are very sober, smart.
I have sat with you in a drum circle. In a sense of one.
I didn't know we were doing.
Some people are still doing that.
You said this was a safe space. I didn't know we were doing that much sharing. But I think that at the end of the day, at its best, this is just niche private markets investing, finding growth trends going like this, cost curves going like this, and valuation dynamics that haven't been picked over yet by the deep pools of capital. Not everything in impact is this, but I think the acquisition for us was a really useful exercise to get a little bit of sober light of day on all of this, right? Because when we were getting acquired, this was a pretty fundamental question Goldman Sachs had, is A, can any of this perform? And B, are you any good at it? And I think it was useful going through that exercise, and I think they certainly came to the conclusion, if they didn't think there were an investment case around doing this that could meet strict fiduciary standards for clients, they wouldn't do it, right? And I think it's been a useful piece of the process. So I think I've rambled, so I'll leave elaborating the last two sins for maybe later if there's time, but hand it off to the rest of the group.
Great. Before we jump into talking about what you're seeing with companies, Bruno, if Jack and Tim, if you each want to chime in just a little bit with your fund experience in terms of performance and how you think about that. On your side, Jack, would you like to start on sort of what Trillium's experience has been on that?
Sure. First, a little story. We have a client that we've been working with for close to 20 years. And this client has asked us to provide her, for her other money managers and her consultant, a list of names that we break down into what we have historically called the greens and the cleans and the dirties, and the idea of the S&P 500. The idea being, if you just invest in the greens and the cleans, you'll outperform the dirties. And it works. Why does it work? Because they keep coming back and asking for this every year. And we found ourselves, as we look at that list, that list itself has in many times outperformed what we're able to do on an active basis, just working with that list. So to the question of performance, if your screens are good, I hesitate to call them screens, but if your research is effective, I certainly believe that is a huge help. And one other tidbit on this subject. Having started doing this many years ago, in 1983, in fact, what I had to do to prove to prospects and clients, I had to show them that they didn't have to lose money investing. At that time, I was very focused on just the E piece of this ESG. And we created a small fund and managed it over 17 years, and it outperformed the Russell 2000 growth by about 270 basis points after fees. That's not a risk-adjusted number, but the point of it is that we were able to do it, and that's been usually helpful, I think, to us in our current life at Trillium and at previous lives at Winslow Management, in getting the dialogue going, and it's to move forward in that direction. So I'll stop there. I have other things to say later.
Great. Tim, you want to chime in on the performance side? You've been involved in this discussion for a while.
Yes, briefly, but I can confirm that Walden Asset Management, where I work, has been doing this for 40 years, and we get the same kind of questions many of you would, or Jack was just referring to, where clients are obviously wanting to know whether they're going to pay a conscience penalty, they might use that term. And the experience is over time, of course, just as you were mentioning with the Meta study, you don't pay a conscience penalty with a reasonable set of screens. So that's the side of the argument where screening doesn't cost you anything. But the other side of this emerging definition of what sustainable and responsible investing is talks about not just screening out, but investing in companies that have a positive record that we believe add value long-term to portfolios. And by the way, Goldman Sachs came out with a portfolio a number of years ago where they chose sustainability leaders, and they actually argued that long-term they believe that will outperform. Why? Because companies that show leadership and sustainability are dealing with important issues of the day that are actually going to protect shareowner value long-term. So one of the parts of this debate that I think is important to put in is not just the experience we've had in managing money for clients, but watching the thousands of companies now who are who are talking about sustainability and being leaders in corporate responsibility or corporate citizenship. They've got their own range of terms they use, right? And if you read a CEO's letter at the beginning of the sustainability report, they will often talk about this as the right and responsible thing to do, but then they will talk about how this protects long-term shareowner value. So that's really interesting to hear us as investors talk about our experiences and what the studies are and what our returns are. But let's watch this other part of the trend as companies are saying this matters too, because managing material risk or managing issues, the range of issues we could talk about from climate to sweatshop labor, these are important issues that impact us as investors. So isn't that an interesting complete circle in this discussion, which I think might help some of the folks who are really skeptical doubters, except the editorial page of the Wall Street Journal that will never see the light on this.
And I think it comes back to something John mentioned, which is this isn't about, I want to see the best ESG funds, which are going to be subpar to every other investment I might make. I want to invest according to my values, and I want an equivalency. And I think that's part of asking that question of your consultants and your managers. Bruno, can you talk a little bit about the performance and your experience in both looking at companies around these issue areas over the last 10 years and what you've seen change?
Sure. So the first thing that I would say is, if you're an active investor, the company that you invest in has to be a business success for you to make any money. I mean, that's where it all really starts. So when you're talking about performance, you're really talking about the identification of business models that are going to succeed over time. And so looking at financial data is always very important, but I would say, remember, when you're looking at financial data, in an abstract, you're inferring something about the human activity inside the company, right? If you look at a company that's very profitable, could be any number of things. They're really good at what they do. They're cutting corners on R&D. They're the low-cost producer of something. They have technological innovation. All of these statements could be true. You have to dig underneath the numbers to figure it out. So you're really trying to figure out, what are the people inside the company actually doing? So when we're talking about performance from the integration of material ESG factors, I'm saying, and I tell my clients, it's really about extending the bucket of data that we consider when we're making an investment decision, and we do it because we think it yields insight in a result. It's simple as that. If you invest in a company where the supply chain is in a low-lying part of Asia that's going to get flooded, it's going to interrupt the production of products, it's not going to show up at the customer's door, it will have financial consequences. If you introduce a defective component into your final product, it will cost you money. On the flip side, if you keep and attract super smart people, you will innovate your way to success. So I'm going to say that this is not a separate asset class. This is not a separate activity from something that other people do. In 5, 10 years, it'll be just very commonplace that this is the right way to invest. And I think about it in terms of all innovation in financial services, right? Before, people invented an options pricing model, and after. After, you couldn't very well go to someone and say, I'm not using an options pricing model to price options. It would make zero sense. In your case, before, after, risk models, you know? After a risk model, how can you say, I'm not going to use one? Same thing in our business, you know. I'm in the highly active side, but we use risk models all the time. I wouldn't think of not using one. So it's really just about that. And I think performance is really derived from insight, and ESG factor integration yields you better insight. Doesn't guarantee success any more than financial analysis does or any other activity, but it's clearly a 2 + 2 = 5 proposition in the end. And at every level of risk, as John said and you said, this works. That's my bottom line on it.
So a question for both Bruno and John. At large firms that are doing, have analysts and are managing money, Bruno, starting with you, what's been your experience? When you started, I think you were probably using this ESG data exclusively. Maybe your other portfolio management colleagues were not. What are you seeing at UBS across the board as they're thinking about this integration?
Well, there are a couple things, and some of them involve cultural change. So the first is, this was a bit of an outlier activity, and I felt a little bit like a missionary in the jungle or something like that. As we started to demonstrate that this worked, and the analysts started to understand that this was a worthwhile activity because it yielded insight, then it got traction, you know. And then as the investment leadership got behind the idea that we should be gathering our own data and integrating it across strategies across the firm, well, then it got more and more momentum. But it did, you had to sort of do some missionary work in the beginning. But I guess I would also say many of our thoughtful analysts thought about these issues. They just didn't label them the way people in this room might label them, right? My tech analyst understood plenty well what the use of water in a fab was all about because it costs money. But he just didn't think he's a geek from MIT. He just thinks about, he used to run a fab, he understands it. But he just didn't march around with a big bag of labels. But that's the key, the focus on the business model and how to get a result.
being just good investing, however you look at it. John, can you speak briefly to what you're seeing play out at Goldman around this issue?
Yeah, your last comment on labels really, really resonates with my experience, and it's a risk and opportunity I think we all face. Number one, good investors don't want to think that if they listen to the finger waggling about doing this, then they need to pack this extra suitcase of labels to carry around. I think it's a fundamental issue, because when you have an investment conversation, you'll often find smart investors are doing a lot more than they would even name. I mean, I was doing part of our orientation, met with our emerging markets analyst that said, I don't do ESG. I don't do it. I said, well, what do you do? I just invest based on the sustainability of cash flows and what I'm paying for them. Well, walk through some examples. And it turns out he was basically at zero weight in energy, because he said volatile commodity price, a ton of CapEx, uncertain pricing and regulatory future, and lousy corporate governance state-owned enterprise, so I don't want to own it. Well, let's talk more. What else? Well, in manufacturing, supply chain, at the end of the day, that's the biggest source of risk for a lot of these outsourcing companies, because our core investment belief is the world is going to converge to EU and US labor standards, because that's the supply chain, and that you're going to blow up in the near term or long term. But we don't do ESG. Right? And I think this is an important thing for you guys in the room that are the ambassadors for this, is don't trigger the ideological response that gets people out of an investment frame. Right? Have it as an investment question and let the investment logic unfold, because if you get people in the ideological world, suddenly they clam up, they think this does. I had an language conversation with a CIO of a $2 billion fund. So said, all this makes sense, all this is good, but what do I do if I've got a great active manager that's performing really well for me and does all these things really well, but just doesn't do ESG? At which point I sort of groaned. I said, I'm clearly doing a bad job communicating, right? At the end of the day, doing these things well is what ESG is. It's not the label, it's not the marketing, it's not the pretty annual report, it's what you do.
So, hopefully having two of the major Wall Street houses sitting here, if you came in thinking that this was still a niche approach to investing, hopefully that has been dispelled. So let's move on and talk about, it was a question that came up in the last panel, and talk about the other kind of impact you can have, particularly owning public equities in this company and starting to change corporate behavior. So I'm going to go to Tim and ask you to talk about, briefly bring everybody up to speed on what proxy voting is, how it works in different structures, and end with what questions people should be asking their managers and consultants about what's going on.
Thank you. This is all part of a broader understanding of what impact means. So John talked about private equity with a definable social impact. Some of us who've been working in the public equity space trying to change companies' practices and policies can point to decades of impact on those companies, meaning changing, altering, helping define, supporting shifts in company policies and practices. So very important, the theme of impact is very real, but it can be an impact in various asset classes, including in fixed income, which we'll hear later. So at Walden Asset Management, I work specifically as the director of ESG engagement, and Walden, as I say, has been doing this for 30 years now. And I formerly, before I worked with Walden, worked for the Interface Center on Corporate Responsibility. So we've actually been involved with investors trying to have an impact on company policies and practices for 45 years now. So I'm going to talk specifically, as Liz asked, about voting proxies, because that's a theme Jack's going to then pick up on a different piece of that, and we'll keep the discussion going. In one of Keith's slides, we saw some descriptions of some of the legal rethinking of, or not rethinking, defining of fiduciary duty. So important for us to remember in this room that the Department of Labor, which Keith had up on a slide, has noted years ago that for ERISA funds, that the voting of proxies is part of their fiduciary duty. They actually says the proxy is an asset. In other words, you shouldn't just throw it in the garbage, right, Keith? It's an asset. It has value. You're being irresponsible if you dispose of it improperly, so it needs to be voted thoughtfully. So obviously that's not a binding rule on other investors in this room or endowments that aren't under ERISA, but the message is the same for all of us. This is, I believe, a duty to vote our proxies and vote them thoughtfully. But the other side, and maybe the positive side of this, is that as an investor, we, as a share owner, we are partial owners of companies. And as such, we have an opportunity, and some would say a responsibility, to communicate with the managements of companies that we own by voting our proxies, by sending them a message one way or the other. Is it just a time-consuming exercise? Does it make a difference at all? Does it have a meaningful impact? So I believe it's absolutely clear that voting has had a significant impact on company thinking and has made a clear and definable difference. And there's numerous examples over the decades that confirm this. So I'm arguing for the sake of this panel that we can watch how companies have changed their policies and practices, sometimes before a vote, because there's a shareholder resolution that stirs a discussion in management and the board, and they talk to the investor who's the proponent of the resolution, and they say, I agree, we'll make this change as requested. So actually a successful shareholder initiative is a proxy that never has to get voted because the resolution has been withdrawn. But let me also suggest that a wise company who's watching votes, whether it's on the pay packages of their CEO or a vote on climate change or a vote on putting women on the board, it could be just a 20% vote. It could be a 51% vote. And in a few cases now we're seeing shareholder votes get about 75% of the vote. Companies are listening to those votes, and sometimes they see it as an early warning system on an issue so that they respond appropriately. So just some quick examples. Companies that agree now to do reporting on sustainability practices, or companies that agree to take steps now to diversify their board, which has been an all-white male board, or a company that is setting GHG goals or getting energy from renewables. These are all being prompted in part both by good management, by many companies. You don't need an investor knocking on the door. But if you're a laggard, sometimes that reminder makes that company change. So, final point here is, what does our vote say about us? If we mechanically vote no on every shareholder proposal on social and environmental issues, what does that say about our belief on climate or women on boards? What does that reflect about what we believe in? That could be a question we look at it too. Conversely, by voting for a resolution on climate change or on a sweatshop issue, we're sending a message to the company, this is important. If you take leadership steps on this, the investors will back you. These are issues you should be watching. So, final points here. We obviously would encourage people to have their own proxy voting guidelines. There's lots of models out there that could be used. But if you have a manager who manages separate accounts for you, please tell them to give you the proxy so you can vote them accordingly, or ask them to vote according to your guidelines. But you remember David, as he was talking from Hampshire College, most of their money's being in commingled funds. That may be true for many here. Different situation, right? You don't have any power over voting those proxies directly. But I believe more and more investment firms who are managing your money for you in commingled vehicles are listening to you as you raise questions about how those proxies are voted. So we can track these votes through the NPX forms, and we can say, how does BlackRock or Vanguard or Bank of New York Mellon or JP Morgan Chase vote their proxies? They vote against every social and environmental resolution, virtually. So that's an astounding kind of statement, how your money is being voted if you're in a BlackRock fund or if you're in a Vanguard fund. And I would think, instead of feeling powerless because you've just commingled your money, you can express your opinion to these funds, and they are getting opinions expressed mightily by many big state and pension funds. And I'll just indicate that last week, our firm, along with others, filed resolutions with Bank of New York Mellon, BlackRock, JP Morgan, and soon T. Rowe Price, calling on them to review their proxy voting guidelines. So I'm suggesting, Liz, that whether you have separate accounts and have power over your proxy voting, or you're in a commingled fund, the time has come to say, these proxy votes matter. It's our money in your commingled fund. We're asking you to be proactive in voting on, say, climate issues or other important environmental, social, and governance issues. Thanks.
Thanks, Tim. And that's actually a great segue, because what Tim just proposed is your first opportunity at shareholder engagement. You are a shareholder in whatever vehicle you're invested in, your university is. And so if you take the opportunity to put it in front of your consultant or the manager, however you work, to ask the question and impress upon them that it is important, you're not expecting it necessarily to change in the next 3 months, but if you come back in a year and there's not a better answer as to how they are voting your proxies, then you have to start seriously thinking about who's managing your money, and is that in line with the values that your organization has set out. And this doesn't change what you're investing in, it changes what you're doing with it. And so as we think about how do these resolutions get in front of shareholders and what kind of shareholder engagement is out there, I wanted to ask Jack to talk about his experience with that and basically explain how a resolution gets to ultimately be voted on.
Thanks, Liz. I'd like to start by saying that we work with Walden and others jointly on some of these proxies that get filed, and that gives us more leverage and has a bigger impact. Before I talk about this a little bit, I'd just like to say that I sit on the board of a public company. It's the 4th public company I've sat on the board of, and I can assure you that directors pay attention to how proxies are voted. And to Tim's point, whether it's 1% or 10% or 20 or maybe more, no matter what it is, they do pay attention. Why do they do that? Well, some of them actually care. Tim. But in many cases, they're advised by their lawyers and their in-house counsel. Look, you have to pay attention to this, and here's why. So that's just another reason that I would encourage you to do that. We've brought a couple of papers, not to send you home with a lot of stuff, but on our approach to shareholder engagement, and then some of the successes that we've had, some working with Walden and others, that could be useful, some guidelines for you if you'd like to pursue it. So let me tell a couple of stories about this, if I might. I've only been at Trillium for a little over a year and a half, and when I arrived there, Trillium was just about to file a proxy for one of our environmentally responsible, healthy living companies about not being diversified enough in their employment practices. This is a company that you probably have in your portfolios if you have anything to do with healthy living. So this company, I said to our advocacy department, and by the way, we've got 5 people working full time on this. Well, before you do that, let's talk to the CEO. Let's engage him, because I can't believe that he wants this to appear at his shareholder meeting on his proxy statement, because he has prided himself for being a leader in the space. So we got a hold of him, spoke to him about it, and he said, "Oh my God, how could we be, I'll call you back tomorrow." And he called the next day and said, "That will be taken care of." So sometimes just having that dialogue, or I don't call it a threat, but just the fact that you're going to file in the proxy makes a huge difference. So I encourage dialogue first, then filing. I'm not sure everybody does it that way, but I really think that's the most effective way. call it the carrot and the stick if you want to, but it really does work. So we've been
I
active.
might just add that
Yes.
for many of you with students on campuses, that's kind of what you'd like them to do when they're not happy about something that's going on your campus. You'd like them to start with the dialogue, not with the sit-in. So it doesn't change much, it's just graduating it.
Thank you, Liz.
I've worked at a university, I know.
So we're. I'm not going to get into the. Do you want me to address the specifics of how you file? Yeah. Okay, everybody knows that. So that's pretty straightforward. The filing once doesn't necessarily work. So one of our holdings is a trucking company in the Midwest, Intermodal Trucking. You probably know who it is, and we've owned the company a long time. We're happy with all the business aspects of it. We're happy about the environmental impact it has in terms of improving efficiency, reducing carbon. But this company was not being particularly proactive in their employment practices. In fact, they weren't being proactive at all. So we had the conversation, and the CEO said, not really. Well, we're going to file, and we filed. And the first round, we got maybe 12% of the vote, which, by the way, is awfully good on a first round. We filed again the following year, and something happened. I'm not sure we can describe it, but we got 52% of the vote. Now, that doesn't mean that the board or the CEO has to do anything. It just means, hey, this is what your shareholders are concerned about. You better listen to your shareholders, because guess what? They vote for you too. So that was a big win for us, and so the point of that is that stay with it. The first round, it rarely works. I think Tim would agree with that. And it too is a matter of education. We've been talking a lot about education and communications, and it's just been it's extremely useful. Even though these companies, whatever ESG screen you're using, I will guarantee you they can all be better at what they do. I can guarantee you that they'd like to have a dialogue with you, or they should have a dialogue with you about how they could do things better, and that's a good way to approach that. So I'll drop it there, Liz.
Liz, can I add two footnotes? One to Jack's point about a surprising vote sometime. So we had resolutions to Emerson Electric for a number of years asking them to do a sustainability report. No, don't want to do it. Too much time, too much effort. We'd have to track things like our greenhouse gas emissions. And the vote, I think it was in the fifth year, got a 40% plus vote. Well, to our delight, this year as proxy season, filing season came up, they told us, we're going to do this report, and it'll be out in 2 months, and then there it was, and it was a decent start, let's say. So that's listening to your share owners, and they were candid enough to write to us and say, that 40% vote was a pretty good litmus test of what our shareholders wanted. We had one resolution to a company called Clarkor. They got a 62% vote. Jack, I don't know how that happens either, because we didn't do any work to get it, but it clearly means big institutional investors were voting for that because it was something they thought that protected shareholder value. So last point here is we talk about engagement, and we talk about proxy voting and the kind of resolution process. For the university community, we want to stress that there's multiple levels of engagement. For example, even with I'm picking on Hampshire again, with the commingled funds that they have, there's opportunities for colleges and universities to sign open statements by series about climate change and what they're looking for in terms of standards on climate. There's a chance to join open letters to companies. For example, if you're concerned about lack of women on boards, there was a letter sent out a year or so ago by investors with $1.2 trillion of assets under management. The door is open to have people join in and sign those letters. And if somebody was interested in a university to actually engage with a company in a dialogue that the company often has with the investors, the door is open there too for you to join in. So that has happened rarely over the years in the university community, but there have been a couple of colleges who filed resolutions. I think Tony can remember part of that list, but I know Bard College and Swarthmore and so on have filed over the years, and sometimes with good effect. So there's a long coattails by the investors who are doing this. They're glad to assist people if you just want to co-file a resolution that somebody is filing and do no more work than just saying, we're a co-sponsor. That's easily done and much appreciated. Thanks, Liz.
Very good. So as we turn it over to questions, I think where Tim and Jack were is this is potentially an opportunity on the campus to engage students because it involves everything that you're teaching them on their schools, how to research, how to engage, how to write, how to dialogue, and so it does present an opportunity.